Confidence is necessary for both trading and any other endeavor one undertakes. There are certain approaches to establishing trust, keeping it, and ensuring traders continue on course. Trading performance suffers when traders lack confidence. There are steps that must be taken to not only gain confidence but to keep it. A solid game plan is necessary for traders to feel secure when engaging in trading. Self-confidence is perhaps the most important of all the qualities you will need in order to become a successful trader. You must have the self-confidence to stick to your trading strategy and the guts to not be influenced by the crowd. Before continuing, if you are new to the channel, don't forget to hit the bell button and subscribe so you won't miss any of the next videos we release. Humans are susceptible to being persuaded away from acting in accordance with their moral convictions. Beginner traders are particularly vulnerable to this occurrence. Self-confidence is difficult to grow, especially for a trader who is just starting out and hasn't had much luck. But keep in mind that every successful trader started out as a beginner. Here we will talk about a few things that will help you stay confident in yourself as a trader. 1. Know your trading style. Finding the trading approach that best fits your personality might be challenging for novice traders, but it's essential if you want to succeed as a professional trader over the long run. Your chances of making money as a trader are better if you select the trading approach that most closely matches your personality. Be honest with yourself. Scalping, day trading, swing trading, and position trading are the 4 basic types of trading. The lengths of time that trades are held account for the variations in styles. Scalping deals are only held for a few seconds or a few minutes at most. Day transactions can last anywhere from a few milliseconds to several hours. It is possible to hold swing transactions for a few days. Trades and positions might last anything from a few days to many years. We all take different approaches to trading. These trading strategies are dependent on a number of variables, including your risk tolerance, trading confidence, and decision-making abilities. It's important to choose a trading approach that meshes with your personality. Your overall trading plan should include determining your favorite trading approach. It determines the tactics you use when you make transactions in the market. 2. Pin down a trading time frame. The trader's trading style or technique filters down to the time frame. Different trading philosophies typically correspond to particular time spans. The trader's thinking and the amount of time they can commit each day fully determine the time periods. You can leverage more effectively and set tighter stop losses while trading on shorter time frames. Larger time frames necessitate bigger stops, which means a larger account, allowing you to ride out market fluctuations without being subject to a margin call. The most crucial thing to keep in mind is that your trading time period should naturally fit your personality, regardless of which one you select. You may make the greatest trading judgments possible with the aid of this in determining the ideal fit for you. The fun really starts once you've selected your favorite time frame. At this point, you start examining several time frames to aid in your market analysis. 3. Focus on few currency pairs. Learn about the markets or currency pairs being traded using the approach. The small selection of instruments in marketplaces is always a smart idea. Asset classes and even the instruments that make up an asset class don't all move in the same way, they each have unique traits. It is advisable to concentrate on only one pair at a time in order to prevent confusion. Each currency pair will have a few distinctive qualities. Thus you might not be able to trade all currency pairs using the same technique. The sole exception is when you trade pairs that have a positive correlation. So, watching many pairs enter profitable trades will be too much for a newbie. Beginners should stick to trading one big pair until they have adequate trading experience and have developed their skills. The most commonly traded pairs are major ones. That liquidity will greatly assist you in being able to enter and exit trades quickly and easily. 4. Calculate your risk tolerance. Your capacity and willingness to endure a drop in the value of your investments is referred to as your risk tolerance. Asking yourself how at ease you will feel holding on to your positions during sharp falls in the stock market may help you gauge your risk tolerance. Your strategy for developing your money without worrying about it constantly depends heavily on your risk tolerance. Knowing your level of risk tolerance will enable you to develop an investment strategy that will help you strike a balance between your concerns about volatility and the possibility of higher returns over the long term. Understanding risk tolerance and risk management are crucial for trading with confidence. This is possibly the most crucial aspect since it guides traders toward accepting the right level of risk with each trade, preventing them from letting emotion override analysis due to a lack of risk acceptance. The analysis is subordinate to risk management. 5. Focus on process, not outcomes. Many new traders are often curious about how to increase their trading profits. They make an effort to set objectives, such as striving to collect a certain number of pips per day or month. It is preferable to put more emphasis on the process than the final result. It doesn't matter that you lost, what matters is that you now know what went wrong and what you can do differently the next time. Putting more emphasis on the process rather than the outcomes will help traders feel more confident when they are trading. To do this, one must have the patience to put less emphasis on the final result. Keeping a checklist, whether it be in your head or on paper, is one approach to achieving this. Additionally, it assists in shifting attention away from the result and maintaining objectivity. 6. When your trading confidence is hit, reflect and repair. The trader may lose the right frame of mind to trade confidently as a result of drawdowns. How to handle a downturn, which will inevitably happen occasionally. To efficiently push the reset button, the first step is to get out of the fire. Review transactions that didn't work out by noting that the market wasn't right for your trading style, etc. It's crucial to remember that the market is always correct. In a lot of ways, choosing not to trade is a transaction. Once problems have been found, the wise course of action is to gradually re-enter the market until confidence has been rebuilt. 7. Avoid trading overconfidence. Maintaining confidence also requires managing times of success and recognizing when those times may be approaching a standstill. It is crucial to constantly remind yourself to maintain your modesty when you are successful, because if you don't, the market will make sure to do so. It might be just as crucial to manage winning periods as it is to manage losing ones. By being realistic about the market and your trading skills, you can prevent overconfidence bias. Analyze market trends thoroughly using charts, news, and other resources, and be honest with yourself about your trading prowess. Conclusion: these various elements of the trading process need to be understood by traders, and they shouldn't minimize their influence. Although it is impossible to control every component of the trading process, making a concentrated effort to handle the aspects you can control might give you a psychological edge in the market. That's all for today's video. Guys, tell us your views in the comments section. And if you're new to the channel, don't forget to subscribe. Thank you very much for taking the time to watch this video. See you in the next video. Cheers.